Welcome back. In this session, I'd like to talk about WeWorks. Now, you're full of high-profile IPOs. WeWorks is up towards the top of the list, a company whose public offering has been expected all year, and it's now finally here. And you'd think there'd be a whole lot of excitement building up. But in the last few weeks, the WeWork IPO, which was filed a few weeks ago, seems to be coming apart at the seams. It slipped sliding away. And here's why. When the IPO was first announced, the prospectus was filed, the expectation was that the WeWork IPO would be priced about 50, 60, maybe more, 70 billion. And that was based on a very simple premise. The most recent investor in WeWork at the start of this year was SoftBank. And they invested in WeWork on a pricing of about 47 billion. So the view was SoftBank is a sophisticated investor. If they paid 47 billion, then they must be expecting to get more than 47 billion. Now, before I go into the WeWorks IPO and value it and talk about what might be going wrong here, let me be very clear with my biases. I've never liked the company. I don't like its CEO. In fact, in general, I don't like CEOs who spend their time telling me how to live my life and not much time talking about how they run their businesses. And if you look at Mr. Newman, who runs WeWork, he has all the hallmarks of a celebrity CEO. But enough with my personal biases. Let's look at the setup for the WeWorks model. What is it? What does it do? Now, if you look at what the WeWorks model is, it's really an old-time real estate model. It's in fact neither new or unique, not particularly tech. So the use of the word tech, I think, is a misnomer here. This is not a technology company. It might use technology well, but it's not a technology company. It's a real estate company. So its model for real estate, though, has been tried before and it hasn't worked. The companies that have tried it have failed. So the interesting question with WeWorks is, what does it bring to the table? And it does bring some very interesting strengths that might allow it to succeed where others have failed before it. So let's look at the status quo of the office space business. If you want to rent an office, here's how the process works right now. Somebody buys a building, they renovate the building, they get it ready, they lease it out. So the owner of a building leases it out, generally on longer term leases, and it is clear that, like all other real estate, it's going to be sensitive to economic shocks. In a recession, there's much less need for office space, but the keys to success in this business are fairly simple. You want to buy real estate when real estate prices are low, and most of the time you got to borrow the money. So it's not as if there's less fixed cost, but there is the fixed cost in borrowing. And then you've got to lock in tenants when the rental rates are high, and then you hope to use that buffer to cover the downtimes when they do come. But even with all those protections, even the most prudent real estate developer will tell you, or real estate operator will tell you, that this is a boom and bust business. That the most high-profile real estate developers been both billionaires and bankrupt at some point in time in their lives. So what does WeWork do that's different? First, so I'm going to break the WeWork model down into steps. The first step in the WeWork model is to find desirable locations. The desirable locations are going to be in cities or towns with tight real estate markets and lots of new businesses that need office space on a flexible basis. So that's the first step, is you need to find a building, you need to sign a long-term lease. So WeWork, for the most part, does not buy its building. So that could change in the coming years. It leases the buildings long-term. Then it spends a lot of time renovating the buildings. Renovating to do what? To give it that cool look. I mean, in fact, the WeWork look is fairly unique. I mean, you got that big We in front of the building, and inside the building you have all the touches that Gen X, Gen Y, millennials like. Kombucha in the tap, to community rooms, essentially it looks like a grown-up's playroom, but it attracts today's workers. They spend time renovating the building, getting it ready, and while they're doing it, they're also starting the pre-selling, getting tenants to sign in. And in the third step, they fill the space with, and they'll fill the space with short-term tenants who need things. I mean, it is the key component of the model. It's flexible. You want to sign up just one office, you can get that. You want 5 offices, you can get that. You want to sign it for 3 months. So essentially, they fill the space with clients who need flexible space. Now, many of these clients are younger companies, startup companies, uncertain about the future, but some are established companies that are changing the way they do business, changing works, the way they do work. Lots of people work from home. Maybe they don't need the office space they did. And once it's filled, they run the building, trying to keep vacancy rates low, trying to keep occupancy rates high, and essentially, trying to collect as much as they can in these rental revenues. So sign the building, build the reno, fill it up, and run it. So I'll give you the WeWork pitch for why they claim they pull this off. First, they of course claim they find the best locations. They find the locations that are most desirable. Then they turn these locations. So this is a timeline from the prospectus. Take it for what it's worth because it's their best pitch. Is they turn the building around in about 6 to 8 months, less than a typical real estate operator might take there to renovate a building. And WeWork claims they can do this because they do it on so many buildings. Economies of scale kick in. And then they start filling the building. And very quickly they start to break even, which is they fill the building quickly. That's their, again, coming from their brand name, the demand for flexible office space. And here's the second pitch they make. Once these buildings are stable, they're occupied and you collect, they claim that they make a substantial profit on these buildings. They measure what they call a contribution margin, which is in a sense what's left over after the cost of running the building. And they claim a contribution margin of 25%. Now they play a little fast and loose with their definition of operating expenses, but they claim that if these buildings run well, that they could make 20% before covering G&A costs and other expenses. Doesn't seem outlandish. So I'll give you an example of a WeWork building so you can see how this works. This is 600 B Street in San Diego. It's a building that was built in it was built a long time ago, 1974, and it's been renovated. WeWork signed the contract for this building somewhere in 2015, maybe early 2016. They signed a contract for about 900,000 square feet. Then they spent about 5, 6, 7 months renovating the building. And you can see a little bit of the pictures of what the inside of the building looked like, that coolness effect. And they essentially came up with the WeWork Reno. They renovated the building. And then they offer space in the building. And you can see some of the examples. You can rent a desk, you can rent an office, you can rent multiple offices, you can rent them for a few months, you can rent them for many months. The key to this model is flexibility so that people who need space for just a few months can fill it in. Sounds pretty interesting, right? I mean, obviously, a lot of small businesses, a lot of startups for which this kind of offering is going to be attractive, and in a space that they find attractive because there are community gathering spaces, they can get together with other startups. WeWork as a company makes a big deal about the we community, and maybe there's something to it, being with other spaces. So here are the model trade-offs. The pluses of the model are first the WeWork look. Clearly they have a twist on how they read. I mean, it's not revolutionary, it's not that you can't copy it, but they clearly have a look that they replicate on every We building that they have. The second is the notion of WeWork community. To give the company credit, it goes beyond the cosmetics. It creates add-on services from business consulting to seminars that they run. It allows the community to network. So maybe you're a small company, you find some other small company that you can work with. And it gives that offer of flexibility. You can sign short-term contracts, just a few offices if you want. And here are the weakest links. The first is the nature of this model, because it starts with WeWorks leasing the building, is that there's high leverage. It's a feature of the model. You're going to have high leverage because those lease commitments are there in good times and bad. There's also a timing mismatch, and that is at the heart of this model. And you can see what the timing mismatch is. When WeWork signs a contract for a building, its commitments run into years, 10 years, 12 years. When it allows its clients, it calls them members, it calls them community members to sign contracts. Those people sign contracts in months or perhaps a year. In fact, the mismatch is very clear even from their own numbers. If you look at the lease commitments, they run 10, 12, 15 years. But if you look at their revenue commitments, they run about a year. This is a model built on a timing mismatch. Now, that timing mismatch is not new to WeWork, right? If you think about a hotel is the same mismatch. The hotel owner owns the building, has to pay the bank payments for years on the road, but the people who check into the hotel, pay for a day, pay 2 days. You're saying, what's the big deal? Why is WeWork more exposed than other companies? And WeWork is more exposed for a simple reason, for 3 simple reasons. The first is their lease, the way they get the building is by leasing the building. You're saying, if you buy the building, you still have to borrow the money. It's true. There's a fixed cost when you buy a building as well, but you can figure out how much equity to bring in. So maybe if you feel your business has too much of a mismatch, you might decide to use more equity when you buy the building. Second, after you buy the building, if the building value goes up, your equity component increases with it. So if you're in a place where real estate is appreciating, a borrow and buy model will lead to more equity, less debt. That's the first. The second is the WeWork model by itself might not be that difficult to manage. But if you're growing at 50, as fast as WeWork has been growing it for the last 10 years, you have a model on steroids. So all the costs are growing, the leases are, and you're going to see this when I show you the lease commitments. The explosive growth is making the model even more deadly. Thirdly, there's a self-selection. You're advertising for tenants who need flexible space. Guess what? You get tenants who like flexible space. And the nature of those clients is if there's an economic downturn, they're exactly the kind of tenants who are going to leave. And finally, to run a business like this where there's a mismatch, you need to be incredibly disciplined about keeping costs under control and responding quickly to changes in the environment. I'm not suggesting WeWork doesn't do that, but there's no indication in their prospectus that this is something that's high on their priority list. Maybe it is, and maybe they're working on it secretly and I'm being unfair, but that worries me. So let's look at the backstory for WeWork, starting by what they're reporting to the prospect. Let's start with the good news. This is company growing. God, is it growing? Look at the growth in every single operating dimension, from cities to locations to members. This, I don't think, maybe I'm guilty of hyperbole here, but I don't think a real estate company has grown as fast as WeWork, at least in my experience. In 10 years, the company's kind of exploded out of the box. That's the good news. Is in every dimension, it's growing incredibly fast. It's a global company. It's signing up. It's WeWork locations all over the world. It's in more than 500 cities. So it's in more than 500 locations, thousands of members. But here's the bad news. It's losing money. The red column is actually the reported operating loss. Now, to be fair to WeWork, that operating loss is after lease expenses, which are really financial expenses, and a portion of their operating expenses are pre-opening expenses, the renovation, the kinds of costs you have to do before you open up the location. So if you treat the leases as financial expenses, you make your operating loss look a little less. So in fact, in this graph, I've got operating income, you've got operating income before rental expenses and operating income before rental expenses and those pre-opening expenses. The pre-opening expenses have two categories. One is just lease expenses. The other actually is the pre-opening expenses. So the yellow column might be viewed as the most charitable perspective, but even with that perspective, the company is still losing significant amounts of money. So it's a growing money-losing machine, and leverage is magnifying everything. In this graph, I have the commitments that WeWork has already entered in. So these are not expected lease commitments; these are contractual commitments. The green column portion of the column gives you those operating lease commitments for the next 5 years and beyond. I've added traditional debt commitments. They have borrowed money on top of their leases, and other commitments which are tiny. But overall, you can see this company has a whole lot of commitments coming due. In fact, if you take the present value of the commitments, they have more than $23 billion in debt outstanding. And this is a company, remember, that has less than $3 billion, $2.6 billion in revenues, and is losing almost $2 billion. Clearly, you got to worry. So let's look at what else is coming in this issuance. At least if you believe the prospectus, the rumor, and some of the details are still forming. They'll probably come out this week or next if the IPO still goes through. The rumor is that WeWork is planning to raise about $3.5 billion. And it plans to use the proceeds, according to the prospectus, to run the business. So it's going to keep the cash in the business as opposed to what? Well, in some IPOs, owners cash out. In this case, that's not going to happen. Because you're going to raise $3.5 billion in the offering, you're going to issue new shares. This dilution coming, it creates a little bit of circularity, because how many shares you will have to issue to raise $3.5 billion will depend on the offering price. So the issuance details are still forming. In my initial valuation, I'm going to assume the $3.5 billion rumor is right, and that they will issue the shares at whatever the value per share I come up with. Now let's look at some of the darker aspects of the prospectus, and many of the darker aspects are in the corporate structure. This is the corporate structure that WeWork. In fact, first, it's not going to be called WeWork. It's going to be called the We Company, and the We Company is going to be a partner in the WeWork Company. That's a triangle, and I can't even quite figure out what's happening in the triangle. And then it's got subsidiaries and sub-subsidiaries holding through. I'll be quite honest, this company deserves credit. It's created more complexity in a few years than most companies can create in decades. And there are reasons for the complexity. One is this is ultimately, as I said, a real estate company. And whether you like it or not in real estate, keeping taxes low is part of the game. Some of this complexity is tax driven. Some of it is driven by the fear of lease commitments not being met. So essentially, by trying to keep the properties separate and acting as if they're independent entities, we is trying to at least give you this illusion of, hey, we can't go down with our leases because if some of the leases don't get paid, only the property is responsible. That's fiction, because if there's a global economic showdown, you're going to fail on dozens of these lease commitments at the same time, and there is no way the company is going to be protected. But some of it is driven by that desire to protect the company from the possibility of distress. But there's a third and darker side to the structure, which is some of the structure is self-imposed, and it seems to be rife with conflicts of interest. For instance, there is a company, ARC, which is going to which is going to buy properties and lease it to We. And the founders and others involved in the We company are going to be owners of ARC, and this seems to be a recipe for self-dealing. I'm not suggesting it's going to happen, but the corporate structure here is complex, and the governance is a nightmare. This is clearly set up to be a corporate dictatorship. Again, this is not new. A bunch of IPOs in the last decade have followed the structure of classes of shares with different voting rights. In this case, in the case of WeWork, Class A shares are going to have one share, one vote, and Class B and Class C shares, which are going to be held by the founders, are going to have 20 votes. So clearly, this is a structure where Adam Neumann, the CEO, is going to have complete control of the company. In fact, the prospectus is brutally honest about this, and it says Adam's voting control will limit the ability of other stockholders to influence corporate activities, and as a result, we may take actions that stockholders other than Adam do not view as beneficial. Consider yourself warned. And that the ownership stake for Adam is more than 50%, and because WeWork is categorized as a controlled company, it doesn't have to follow the typical requirements of a corporation to have independent directors on its compensation and nominating committees. The company, you can find fault with, but it's being pretty open about the fact, hey, don't expect this to be a corporate democracy. It's not. So with that background, I'm going to tell you my WeWork story. I am not a pessimist on WeWork. I don't like the company, but I believe that it meets an unmet and a fairly large need for flexible office space. That demand is coming from both younger and smaller companies and more established companies experimenting with new work arrangements. I think WeWork has created a brand. In fact, as part of this exercise, I've talked to people who work in WeWork buildings, and they like the setup. They like that there's a brand name being built up around WeWork, both the WeWork coolness factor and the WeWork community. And clearly there are economies of scale here because you're doing this in dozens and dozens of buildings. We can debate how much it is, but it is there. And finally, the continued access to capital is going to allow them to do things that traditional real estate companies cannot. So it starts with some strengths, and it's going to translate into the following pieces of my story. I'm going to assume that revenues will grow 60% a year. That seems low relative to the 115% next year, but I'm going to take the 2.6 billion in revenues they had in the most recent 12 months and make it 80 billion by the time you get to 2029. Incidentally, given that WeWork itself estimates the size of this market to be 900 billion, 80 billion will actually put them around 8.5% of the market. So I'm giving them a pretty hefty chunk of their own market. And I think they're being generous in estimating the size of the market. I am going to assume, and this is a big one, that over time their operating losses will become operating profits. And I had to search for what the margin would look like once things settle down. Now, I'll give you some starting numbers. The margin for real estate operating companies is about 7.5% to 8%. IWG, known as Regis, which is a company which is pretty close to WeWork in terms of its business model, has had a margin on average of about 11%. So IWG is probably the company closest to WeWork. I do believe that WeWork has some advantages in terms of branding and pricing power over IWG, but I'm going to give them a 12.5% margin. Incidentally, if you remember the 25% contribution margin, that can't translate into a 25% operating margin, because even if you believe the company, they get 25% margins at each building. After you subtract out G&A and the other expenses like shareholder stock-based compensation, you're going to very quickly start to winnow that number down. So the 12.5% is not inconsistent with a 20% margin, at least at the building level. And finally, in terms of reinvestment needs, I will assume that they're pretty capital intense business. This is a capital intense business built through the leaseholds, will continue to stay capital intense. I'm going to give them $1.68 in revenues for every dollar of capital invested. Again, to show you that I'm bending over backwards to be optimistic. Right now, they get only 11 cents of revenues for every dollar of capital invested, but that's because they're still, they're in the growth phase. They're acquiring new buildings. Many of these buildings haven't come online yet. So I'm giving them $1.68 in revenues for every dollar of capital. Now, to complete the input loop, there are two other things that I have to bring into this valuation. The first is, I can't deny the fact that this company might, in fact, the dice are loaded in terms of if the economy turns bad, the company will clearly have trouble making it. That $23 billion debt load, if, at least for the next couple of years, is going to expose them to risk of failure, because a global economic slowdown will affect them perhaps more than most of the real estate companies. I'm going to capture that with a 20% chance of failure. My cost of capital is going to look low to you when you look at the valuation, but cost of capital, that doesn't bring in that failure risk. So the failure risk is a much bigger factor, and I'm bringing a 20% chance that the company will not make it. If the company doesn't make it, it'll be forced to liquidate its holdings. I'm not assuming that will be liquidated at zero. I mean, I'm assuming you're going to get about 60% of fair value. So I am trying to be, again, fair in my perspective. The debt load, if you count in the traditional debt, will give them total debt of about $23.8 billion. So with that story of 60% revenue growth, a target margin of 12.5%, $1.68 in revenues for $1 in capital, I value the company. And the value that I get for the company is about $13.75 billion. Get for the equity is about $13.75. So that's after I adjust for failure, after I subtract out debt, I get $13.75 billion. Now, the number of shares is still in process, but so I'm going to wait on converting that to a per share number. 13.75 billion in equity. That's way below what SoftBank thought was worth in January, what WeWork thought at the time of their file for the IPO. But given the structure of the company and given my story, 13.75 billion is what I see as the value of equity. Now, of course, I know I'm going to be pushed from both sides, accused of being too optimistic and too pessimistic, and it all boils down to two key numbers: what we assume about future revenue growth and what we assume about what will happen to margins. So in this table, here's what I've done. I've looked at 5 different measures of revenues, from 40% compounded growth to 80%. And remember, the compounding effect is massive here. With an 80% revenue growth, I have 191 billion in revenues 10 years from now. With a 40% revenue growth, my revenues are only 30 billion. The target margin ranges from 5%, 7.5% is pretty close to the real estate average. 15% is above the 12.5%. It's probably closer to that 25% contribution margin. Saying, what are all those red boxes? That's where my equity is negative. When you carry a $23 billion debt load, you got to get above it for equity to be worth a lot. This is a company that's on a knife's edge. It's a hugely levered company. It could be worth almost 100 billion, or it could be a company that has an equity value of minus 30 billion. So as you look across the parameters, you can see why disagreement about the company is so wide and why people are so reluctant to jump in at a $60 billion value. The $60 billion value goes into a box that looks pretty optimistic. It could be plausible, but it's clearly not probable. So then the question becomes, why the numbers are so incredibly volatile. As I said, this is what happens when you supercharge leverage. This is a supercharged leverage model, both financial and operating leverage. The scenarios here that I've listed are possible, even plausible, and you can see the wide range of values. And looking at that table, I have the sense that when you buy WeWork, you're buying as much an option as you are a traditional going concern. In other words, the nature of the leverage here makes WeWork look like an out of the money option. Now, it doesn't make it a bad investment, but it's a very different kind of investment. So, it is a story stock, and I think that I've long argued that valuation is a bridge between stories and numbers. And there are some companies where it's all about the story, and WeWork strikes me as being a story stock. It's been marketed as a story stock, and with a story stock, there's a danger that the numbers fade into the background. I have a feeling that that's happened with WeWork in its quest for capital, that people haven't even looked at the numbers. They haven't been careful about the business model because the story sounds so good. In fact, it has all the characteristics, at least, of a runaway story. And this is something I concocted when I saw what happened at Theranos 5 years ago. In a runaway story, here are the ingredients. You have a charismatic storyteller, spinning a story about a big market that they're going to disrupt, a market that you think is not very efficiently run. And along the way, it's going to accomplish some noble purpose. With Theranos, of course, it was Elizabeth Holmes who was the charismatic storyteller, telling about this blood test with 2 drops of your blood that was going to disrupt the blood testing business. And of course, your enemies are all lined up, right? The status quo is your enemy, and your noble purpose along the way, you're going to save the world. You're going to bring blood tests to parts of the world that can't afford it. Come on, who doesn't want the story to be true? That's the nature of runaway stories, is you want the story to be true, that you suspend your questioning and you believe. The pricing gets pushed up. If you look at WeWork until very recently, it had all the characteristics of a runaway story. CEO and Adam Newman, who's a charismatic storyteller. I mean, I was watching him on TED. The guy is a great storyteller, telling a story about disrupting this old, stodgy real estate business by offering flexible workspaces. And he's doing this to save to create a we community of small businesses and entrepreneurs. Hey, that's a great sounding story. And VCs bought in, right? This actually shows you how WeWork has built its value up over time, and it lists out all of the VC rounds. And as you look at all the players, you can see some big names here. You see Benchmark, you see SoftBank, and SoftBank keeps coming back and back. There's somebody at SoftBank who clearly buys into the story. Collectively, SoftBank is the largest single investor. They, I think, invested more than 10 billion in different stages. They were, in fact, the most recent investor. In the January 2019 investment they made, they priced the WeWork at about 47 billion. That's a platform from which the company's gone public. You see, these are smart people. They wouldn't fall for a runaway story. Runaway stories, that's the nature. Even smart people suspend asking questions. The problem with the runaway story is you're building a story based on a personality. And the story rests on how much you trust that personality. And if faith in that personality gets shaken, either by things that person does or actions they take, the whole story can very quickly spin and become a meltdown story. And here's what happens in a meltdown story. You have a storyteller you don't trust anymore. They're now telling a story that's at odds with the numbers. It's always been true, but now you notice that the story seems to be at war with the numbers. And you also take a look at the business model and say, that's really not a great business model. You're saying, why didn't I notice that before? With runaway stories, as I said, you cover it all up, you let it pass. Now that you don't... And I have a feeling that this happened to WeWork in record time. It's amazing how quickly the company is gone from a runaway story to a melt. It happened in the 6 weeks since the prospectus, the 4 weeks since the prospectus. You're saying, what happened? I'd attribute it 3 factors. One is, I don't know. I mean, Adam Newman strikes me as a smart man, but he's been remarkably short-sighted in how he's acted around this IPO. Starting with the sale of $800 million of shares leading into the IPO, that doesn't reveal a whole lot of faith in your own story. That his demand that the company pay him for the We name, I think it's 5.8 million, not even 5.2 million. That seems almost petty. When you're going to be a billionaire after this, why would you want to collect 6 million? And then the conflicts of interest you built into your own corporate structure. I don't know whether he thought that he was beyond questioning, but there's been that first step was arrogance. Second, WeWork has always played games with accounting. It finally is caught up with it. After all, this is a company that describes itself as a tech company when the facts clearly show that it's a real estate company. And it's also the company that coined that abomination called community EBITDA. If you get a chance to Google it up, I have never seen a worse definition of earnings. Pretty much every expense gets added back. All of those past sins are catching up with it. And finally, this is a company whose biggest risk, clear and present danger, is that mismatch. You would think that they would spend a chunk of their prospectus talking about what they do to minimize that risk. There's not a mention of it. It's almost like they bob and they weave and they completely go into denial. The story shift has happened, and I can't tell you when it happened, but the result is the meltdown you're seeing in the pricing. Just a couple of days ago, stories started emerging that WeWork was considering revisiting the pricing, that the 60 billion might become 20 billion. I've never seen a markdown that big on an IPO. And there is a possibility that the IPO might get pulled, that SoftBank, which after all has priced the company at 47 billion, doesn't want to go. So if you're a VC or an equity owner in WeWork, I mean, there is talk about pulling the IPO, but here's the challenge you face. You're waiting for a better moment, but what if your best moment has passed? What if the magic is gone? What if you're not going to find that runaway story again? So I'm not sure waiting is going to get you a $60 billion value again. As an investor, I mean, this company's got to be right. I mean, I would buy the company at the right price. I wouldn't buy it even at the $15 to $20 billion because it looks overpriced. But if it dropped to 8, 9 billion, I think the optionality and the fact that it is meeting an unmet need might attract me to buy the stock. But that might be hoping for too much. It might never get to that number. If you're a trader, this stock is going to be a pure pricing game if it goes public. It's going to be driven by mood and momentum. Look how much it's moving even before it goes public. And if you're a founder, CEO of your own company, there's a lesson that you should learn from WeWork about being humble, about staying away from hubris, about riding that runaway story, because you ride the runaway story, it's like riding the back of a tiger. Sooner or later, you're going to get eaten. So I think there are lots of lessons in this process, and the process is not over. I'm waiting to see how this IPO will unfold. But I thank you for joining me in this conversation. I hope you've enjoyed this talk.